A record $7.6 trillion in cash is currently parked on the sidelines of the financial system. That's more than ever before, and the last three big cash piles coincided with the 2020 pandemic, the 2008 financial crisis, and the 2000 dot-com bubble. These were times when fear drove investors away from risky assets like stocks and towards cash, making this look like a bearish signal, at least at first glance. This cash is in money market funds. That's mostly short-term government bonds like treasuries, and it's not really doing anything besides soaking up high interest rates without much risk. Money market funds offer an annualized return of around 4.25%. That's for risk-free short-term bonds. Compare that to the measly 0.6% you'll get from a standard bank savings account, and it starts to make sense why so many investors have flocked to them. These funds are also highly liquid, so money can be withdrawn and quickly reinvested in other assets where investors perceive better returns. But it's a wonder why that hasn't happened already, because it sure looks like the stock market could bring better returns. But the stock market comes with risk and uncertainty. This big dip back in April 2025 is a case in point. Trump's tariffs threw everyone for a loop. Unsure what was going to happen next, the markets tanked, and economic policy uncertainty reached an all-time high. It's come back down, but it remains elevated. When this measure is high, it signifies a general uncertainty about what's going to happen next. And when it comes to investing in riskier assets like stocks, investors want as much certainty as they can get. So this elevated uncertainty is incentivizing cash on the sidelines. But the rush into money market funds goes back a few years. It really kicked off in 2018 as the Federal Reserve began hiking rates after years of hovering near zero. It stalled during the pandemic recession, then bolted back up again in 2022 when the Fed launched its most aggressive rate hiking cycle in decades to combat post-pandemic inflation. As a result, the yield on short-term government debt, the primary ingredient of these funds, soared. This trend picked up pace even more in 2023. A localized banking crisis collapsed confidence in traditional lenders, pushing investors to seek the perceived safety of liquid assets like treasuries. But the Fed has begun slowly cutting rates again. If that continues, and as the risk-free return on cash drops, investors are expected to pull their money from safe assets and hunt for returns in riskier assets.